All right. That has been a while since we've been live. I have been lagging on my end. Let's see. There we go. Before we get started, will you just confirm that you can hear me okay? That audio is okay? All right, so leave me a comment if you can hear me. Just give me like a thumbs up or yes, you can hear me. Give me something that is very obvious that audio is working. Last time I went live with you guys, it was like 4 minutes of me speaking with no audio. All right, audio's good. Confirmed, audio's good. Legends. Okay, we are live. Stock market, interesting weekend, interesting morning. You guys following the headlines? There we go. We got audio. Yes, awesome, amazing. Okay, we are on every platform now. Stock market that's a big one. Dow Jones down, over 1,000 points. Looks like it's kind of climbing a little bit, but Dow Jones getting hit. S&P 500 down 3.1%. NASDAQ down 3.4%. All right, gang. Here's a couple things. So before, if you guys haven't seen my video, let's go over just a couple things real quick on why this is happening. I'll start by saying do not panic. There is no need to panic when the stock market moves. It's the stock market. It does this. This will not be the last time. It'll do this over and over. That's what the stock market is. It moves quick. Remember, there's something about when you have an investment and you can get liquidity easy, that means that investment is going to move insanely quick in relation to news headlines, right? So basically, if we come off of Friday we have a jobs report that doesn't look that great, right? We had 114,000 new jobs. I think they were expecting 179,000, but what we expected was like a revised version. They originally thought it was going to be more than that. So that did not help. Now, there's been a lot of, actually, let's go into a little bit more detail. This is actually something that I think I have the luxury of. Doesn't mean it's always right. But when we were seeing the jobs reports over the last 6 months, they looked pretty rosy. Like everybody was talking about soft landing, that we were doing well. The Fed was crushing it. For like all my friends that are business owners, what they were experiencing was completely different than what the news was talking about. Like most of my friends that own businesses, they were like conserving cash. They were not really on like a buying or not on a buying, on a hiring frenzy. They were kind of like bracing themselves. I would say that was like what I was hearing from a lot of people. If you look at the actual jobs reports, I mean, dude, a lot of those were government jobs. Like that does not really show the health of the economy. And then I would say the last thing, because I have over 600 investors, right? And we talk to a lot of investors every day, not only our current investors, but new investors coming in. And because we built our company for, what is technically called the retail investor, right? Like I didn't build this company for super high net worth individuals or single family offices. I built it for people that were like me in the pursuit of financial freedom. And the challenge you have is the majority of that investor group is heavily swayed by headlines. Like they listen to something going on and they immediately act. And what we were seeing about 12 months ago is headlines were making decisions for investors. I want to invest right now. Oh my gosh, I saw a headline. I'm going to pull back. This is probably the most important thing I'm going to leave everyone with as it pertains to just investing in general. You cannot make decisions out of fear. This goes beyond investing, but for investing, do not make decisions out of fear. It's the inexperienced investor who does that. And I'm telling you right now, the sophisticated investor takes advantage of that. When they start seeing, the retail investor act in ways that's not truly supported by data, they pounce on it. They start gobbling stuff up. So we have to be really careful that we're not making decisions in fear. The thing about the stock market, this is the thing that I want everybody to know. The stock market is more volatile because you can pull your cash out. It should be viewed as a long-term investment. Like, we get in trouble. Let me take a step back. This is going to be a little bit of a shot at the day traders. And look, that's not to say that there's not day traders out there that crush it. There are. They are the exception to the rule, though. That is not the majority. The majority of day traders lose money, and they lose money over and over. So, day traders are the ones that feel this more. If you're a long-term investor, who cares what happens in the stock market this year? Who cares about what happens next year? When you have a long-term outlook, these valleys don't feel that deep when you're looking at it over, let's say, 30 years. Now, if you're older and you're not investing for the next 30 years, your investment strategy probably changed, and you might not have as much invested in the stock market than maybe you had in your 30s or 40s. Here's another one, though. See, you guys know how I'm investing. I invest the majority in apartments and storage units. With apartments and storage units, that market corrected for us a year ago, a little over a year ago. And so we've kind of been on a buying spree there. What's really cool about real estate, and this isn't going to be for me to pitch you to go all in on real estate. I just want to let you know how the investment strategy works well when doing it the correct way. And that is, you want to try to get yourself in a position where you have, between 8 to 10 investments that are uncorrelated. This is the big one. So, commercial real estate moved 12 months ago. It's not moving today. Like, commercial real estate is not going to have an impact based on what we're seeing the stock market respond to, jobs acts. And part of that is the Fed. So that's one element that you can have that's uncorrelated to the stock market. Traditionally, that's been bonds, right? The stocks are up, bonds are down, and vice versa. That was a way to get, an uncorrelated investment. In today's market, that's a little bit harder. But looking at alternatives in general, right? You could have real estate, which is what I do. You can have, on the debt side of the lending piece of real estate, you can lend money out to commercial real estate. You can invest in venture, in tech startups. Even though tech's getting hit, that is a way to get an element of uncorrelated investments. So be mindful of that. If you have all of your money in stocks and bonds, well, you're going to feel these swings a little bit more. I'm going to look real quick at some questions just so I can check them out. We got Seth Goodwin. If you guys aren't following Seth, please follow Seth. He gives phenomenal financial content, and it ranges all the way from like the foundation, how you should be buying a car, how you should be building your budget, all the way up to more sophisticated investments. If your portfolio drops $100K in one day, you're going to be fine. Okay, here's the big one. And I'm going to tell you guys a story of what I learned in 2008. A lot of my audience is younger. You didn't go through 2008 like I did. Some of my audience is actually older than me, so you're going to remember this well. 2007, 2008, for me, how old was I? 25 or so, 26. That was the first recession that I really went through having some money. And it was a bad one. Now, everyone around me, I'm talking about friends, family, social media wasn't really cranking, but like the news, it was crazy. Every single friend that you saw was talking about how much money they lost. And it's really easy to get caught up in that hype. For me, I was 26. Everybody's talking about how they lost half of their net worth, right? I'm worth $1 million. Tomorrow, I'm worth 500,000. It was big. And then I was listening to people who were in my life that were planning on retiring say things like, I'm not going to be able to retire now. Like this destroyed me. I'm going to have to work for the next 10 to 15 years. This is what I learned. And thank God I had help through it. Me listening to everybody talk about how much money they lost, I immediately thought, oh my gosh, I've lost a lot of money. I should sell before it gets worse. And if I didn't have a mentor in my life, there's a good chance I would have sold and realized the loss. Now, when I called him, you guys have heard me talk about Randy before. I called Randy in a full-blown panic, right? I was 25. Called him in a full-blown panic. Randy, we've lost so much money. What are we doing? Why haven't we sold yet? Half of my friends have sold. Like, I'm just bleeding out here. What do we do? And I'll never forget what he told me because it sounded crazy at the time. You guys have heard me speak about this. It still sounded nuts. He goes, Mikey, not only are we not going to sell, we're going to be buying. And I was like, buying? Why would we be buying? Everyone is selling. And basically the plan that he played out was, dude, this is why we've been conserving cash for so long, so that you have what we call opportunity cash. So you have cash to buy in these dips. And I remember asking him, yeah, but like, Randy, how do you know that like this is the bottom? And he goes, that's not how we make decisions. We don't make decisions on like where the bottom is and where the top is, because you never know, right? Once you think it's the bottom, it's already rebounded and you've already kind of missed the bottom. So what he said is, we're going to look at good investments first. Do the fundamentals of that investment work? How's the cash? What's the growth like? What's all the factors, right? And if it's a good investment, well, we're going to buy it, because that means right now we can buy it at a discount. So that was the first thing he said to me. The second part is, and I never thought of it prior to this, he was like, look, a lot of people who are more disciplined just don't sell during a crash, but they also don't buy. And here's the thing. If you lose 50% in that case of your portfolio during a downturn, you don't just need to make 50% to get back to even. You got to make 100%. So he was saying, in these moments of buying, it actually really helps you not only get back to where you were, but beyond. So I remember just trusting him, right? I'm like, okay, dude, let's buy. And probably 2 years after that, my entire view of investments had changed. And I knew that was I would never go back to the person I was, because not only had I rebounded, I was making money. And I was looking around at so many of my friends that realized the loss, that were like, oh my gosh, I've got to grind for the next 10 years just to get back. And now I'm in a position going, dang, I never really lost anything because I never sold. And now I'm like making money. And so it's really important to know that, one, if you don't have somebody in your life to run these ideas by, and you're someone who makes decisions, like, you just know this, like, you're more of an emotional person. When things happen, you get kind of more wound up. You have to find somebody to help you. You have to find your guardrail in a sense. So if you're more of an emotional person, I'd really recommend getting a financial advisor. Get somebody who can be that voice of reason when you're concerned. Now, if you're not as emotional, I'm actually not that emotional, you got honestly more options. It just is what it is. You could do robo-advisors. You could, work on your investment strategy yourself and just be more disciplined, that when things like this happen, this is probably not a sell time. This is probably moving into a buy time. Now, we do have social media today. This has added fuel onto the fire in a way that I didn't experience in 2008. Be really careful with the headlines. Be really careful with, X or Twitter. Like, they're quick on stuff and it gets fiery. Even with content creators, like, be mindful that the job of most content creators and absolutely all media is to get your attention. So you're going to get attention through fear. That grabs attention more than optimism. So just be mindful of that and stick to your guns, right? Like, one of the best things I ever heard about investing is that investing should be boring. It should not be fun. It should not be exciting. It should be like watching paint dry on a wall. If you're amped up and you're like psyching and you've got like a thrill feeling when you're investing, you're not investing. Like, most likely you are full-blown gambling. So be mindful of that. Okay, I'm going to check out some questions. Let's get into some. Would this be a good time for a new investor to start small? This is such a good question. If you're a new investor and you don't have a ton of money, should you start small? The answer is absolutely you should start. And here's kind of the kicker. That's not going to sound right when I say it. It doesn't even matter if the market's down. Even if the market was where it was 2 weeks ago, I would tell you to start. Start at a high, start at a low. It doesn't matter, just start. It's the most important thing about investing. The other thing is, get used to creating a discipline, right? Discipline, I'm telling you, is the largest factor to success in anything you do. Investing, starting a business, wanting to be a creator, whatever it is, discipline is the key. So this is what I want everybody to do who's new. It's not about putting a lot of money in if you don't have it. It's about creating a system that you're going to stick to. A lot of people use dollar cost averaging as their system. And honestly, it's a pretty good strategy for you to remove emotion. Pick the days that you're going to be investing in the stock market and automate it, or whatever you're going to be investing in. And if you're going to invest every other Tuesday and you're going to invest $50 every other Tuesday, stick to it regardless of what the market does. That's a great way to average out your buy. And the results from that are it's proven. It's really solid to do that. Okay, my portfolio is up 50% in 2 days because I bet on volatility index funds. Kevin Foreman, all right, my man, look, you're probably going to be part of the 1%. There are people that invest in volatility and can make a lot of money. Absolutely. It's just the minority. The exceptions are the ones to do that. The masses do not succeed there. So, Kevin, if you know what you're doing, you've been doing this and you're making money, you've got your strategy. For the masses, be very, very careful doing that, right? But look, I'll take it a step further, and I'll even take that into to what I do, right? I'm in real estate. There are ways to invest in real estate that are much more risky than what I do, right? My strategy on real estate actually fits my strategy across, any sector, even the stock market. I'm a long-term investor. I want to maximize upside while minimizing downside. I don't really go swinging for the fences. Now, in real estate, what Kevin does with day trading is going to be like flipping, right? If you're a home flipper, you're flipping real estate, that's going to be a larger return in a quicker timeline. The thing about flipping, you can absolutely do it and make money. I have a lot of friends that crush it with flipping, but there is more risk when you do it. Higher return always comes with more risk. And so, if you're looking at real estate, the only way you make money on a flip really is if you sell it, right? So you're going to buy, you're going to add value, and you're going to sell. And single family is where most people do this. Single family works very different in comparison to commercial real estate. It's based on comps. It's based on people's feelings, really. And commercial real estate is not. Commercial real estate is valued more like traditional business. It's valued on the income that's coming in, and it's valued off a cap rate, where if you're comparing that to business, it's like a multiple of EBITDA or a multiple of your income. And so the more efficient you are at running your apartments or running your storage units or running your industrial building, the higher the value is. That's not how single family is. So you have to be very careful on the exit, because there's a very good scenario that you buy a home, you flip it, and by the time you sell it, the market changes and you're losing money. So you can take on more risk in real estate as well. I just recommend more of a long-term strategy, because the real estate that I buy, I like to hold. I don't like having real estate that I have to worry about during downturns. I want to buy during downturns. So I would keep that in mind. Tesla Glass, buy 3 to 4 million worth of homes and rent out a $1 million house. Okay, so I've always found rentals to be a really good strategy. What I would say on single family, this is something, I'm going to move into real estate for a second, but we'll get back to the stock market. With real estate, just keep in mind that single family is more volatile than commercial. And so if you're investing in single family, even if you're buying it to rent, you need to understand the markets that you're investing in. You're starting to see corrections happen in these markets that dollars were just flooding, right? You have Texas, you have Florida. A lot of those markets have been developing. Like, you're seeing huge increases on the supply side. The other thing we saw, and I'll do a video on this, we saw from on the real estate side, a 50% increase of homes falling out of contract in June versus, I think it was the prior month. What that means is 50% more of people that had a home in escrow fell out prior to closing. Now, if you look at the why, they're going to tell you little reasons. The biggest reason why it's happening, they can't qualify for the financing. So basically, you can come up with the down payment in a lot of cases a lot easier than you could in the past, right? From 3.5% to 10%, and if you want to go higher. So that means you might have the down payment. You might be qualified from a lender to go put an offer in on a home. It doesn't mean you're approved. So what's happening is people are locking in the home under escrow, and then basically, the bank is underwriting them and going, okay, interest rates just went up, property tax I'm going to consider, insurance just went up, and now the percentage that they're going to have to pay all in for these factors is going north of 40%. And the lender's going, I'm not lending to you anymore. And they're falling out of contract because they can't qualify for the financing. So be mindful of that. There are markets where you're going to see a correction on single family. And so if you're investing in some of those markets, make sure you're running your numbers to see if you have to give a discount on your rents by 20%. Can you still pay your expenses and your debt service? What I'd recommend, if you're making an investment in real estate and you have to pay that real estate every month, meaning the tenant can't cash flow the building, I don't like those type of investments. That's a lot of risk for me. Breaking news. Thousand Oaks City Council now in charge of foreign affairs. Seth, you are such a legend. You're the freaking man. All right, let's see what's going on. Let me get some questions answered. Shonda Sumter, I'm doing well. I hope you guys are crushing it. I have some friends now that I'm actually bumping into more friends that live in South America, and everyone seems to love it. Inappropriately in a live stream. That is why you're a joke. Inappropriately in a live stream. That's why you are a joke. I don't understand what that means. Casey Clark, if you're still here, I have no clue what that means. If you would like to jump on this live with me, let me know. Let's flush that out a little bit. Okay, by little kiddos keep ignoring reality. Have fun playing Monopoly. Okay, my suggestion, bro, skate more. I am not mad at anybody who wants to skate more. If I'm up on the stock market now, should I sell, hold the cash, and buy back at the low? Really, really good question. Okay. What he's asking is, if you're up on the stock market and the market's crashing, should you sell your stocks, sit on the cash, and then buy again? What I think is the best strategy is having what's called a buy-sell discipline, right? This is basically a trigger that's going to tell you when to sell and a trigger that's going to tell you when to buy. So everyone, if you want to write this down or just keep a mental note of this, create a strategy box, right? And have the percentage that you want in stocks, bonds, if you have some in real estate, if you have some in venture, you have cash, right? Create all the quadrants that you want to build out your entire investment portfolio. And put the percentages that you're targeting in each, right? So let's say stocks and bonds, right? We're going to want 30%, okay? We're going to go real estate. We want 20%, right? Get yourself to 100%, including cash. Then what's going to happen is you're going to see those percentages fluctuate, right? The stock market's going to go on a boom, and your 30% is maybe going to go up to 45%. Real estate, maybe real estate goes on a boom and you see your 20% go to 30%. When it gets over your threshold by a decent amount, right? 10% for sure. That's going to be your discipline that's going to say time to sell. And that's usually when people, it's called a rebalance. They sell to get them back to that percentage. And then they use money to allocate or buy in other areas that are down. So the same is true when the market corrects. If you have 30% allocated to stocks and the stock market goes down and now it's 20%, this is your trigger that you need to buy and get it back up to your, what would it be called? Your percentage, your targeted percentage, right? So what that helps you do, it helps you buy when it's low and sell when it's high. That's the best way to do it. The hard part about not doing it that way and just selling your stocks and then buying at the low, one, keep in mind that when you sell stuff, that's a capital gain event, so you're gonna have to pay taxes. And two, it's really hard to know where the bottom is. It's really hard to time time the bottom. So I've found that when you do it this way, you're not timing anymore. Okay, let's see if KC responded. Let's see if he wants to. Not you. Oh, my bad, Casey. I thought you were talking about me. Okay. They weren't talking to you, Mikey. They were talking to the clown in the comments saying you are responsible for the genocide. Okay. Got it. Okay. Given the stock market, I recently watched a documentary called Grab about big players buying up food and water rights. Do you have any thoughts regarding how to capitalize around this movement? Well, look, anytime you have either a thesis or a theory or a trend that you're seeing, just know that you are making a risk. So if you're going to start chasing stuff like that, I would recommend making it a percentage of your portfolio that you're comfortable losing. This is not me telling you not to invest in the stock market, but I would say there's one element that probably drove me to wanting to invest in commercial real estate way more than the stock market. And it was stuff like that. Like the feeling that the big players were able to manipulate the market. Did everybody see that, Charles Schwab and there's a bunch of platforms that, went down today. So people couldn't lock in. They couldn't log in while this, massive sell-off was happening. Look, that could be a coincidence. The majority of people that I asked in the story thought that was, on purpose to stabilize the market. Who knows? My only point is this. There's an element of the stock market that I never felt like I had control of. And I always felt like there were people that were able to move it in ways that I would never be able to contend with. And so I liked moving into investments that didn't kind of have that at play, that I felt like I could control, that, some big fund couldn't come in and change how my investment was. That's why I started moving into more alternatives. But look, there's a lot of good things about the stock market, liquidity being a good one. Hey, Mikey, you need to invest in some Wi-Fi extenders. Is the Wi-Fi choppy? Yeah, we gotta figure out this Wi-Fi. Seems like we might have just dropped. Did we lose Wi-Fi here? Is it better to find an investor partner when trying to flip a property or pull a loan via the bank? Colossal. I'm going to explain that in a second. Will a couple of you just give me a thumbs up if you guys can still hear or see me okay? Kind of looks like maybe we had a little bit of a connection error. Can I just get some thumbs up, or you can hear me, or let me know that it's not going okay? It seems to be in and out. Gosh darn it. Okay. Looks like we might have to wind this one down. Okay. We're in and out. Got some thumbs ups. Okay, we're going to get at this. Is it better to find an investor? Is it better to find an investor partner when trying to flip a property? Okay, really, really good question. One, if you want to do real estate yourself and you think that this is the beginning of a strategy or the beginning of you like building out like a large portfolio, well then do it yourself. I think that's a valid way to go about it because you're going to learn. Now, chances are there's a percentage of you that will not make any money. You actually lose money doing it, but you can definitely make the argument that you're paying for your education, right? The other strategy would be invest with others in the beginning, be a part of the partnership, learn how it goes, then do one yourself. And then the last one, and that's what my company's built for. It's for investors that want to invest in real estate, that don't want to do the work, that aren't the experts in it, or they're spending their time building out their business or their career, and that's their biggest opportunity to make money. But they want, money invested in real estate. They want cash flow. They want appreciation. That's where companies like mine come in. And so you just got to pick accordingly. What I did when I was skating, one, all I wanted to do was skateboard when I was a pro skateboarder. And two, I didn't want to take time away from my career to then go build out a real estate portfolio. My career would have finished a lot sooner than it did if I would have done that. So I was finding people who were investing in the asset classes that I wanted to invest in, and I was investing with them. And then when my career ended, then I started, got into business. We got into the beer industry, and then I created a private equity real estate firm. And now I do for others what I was investing in other people doing for me. So no right or wrong there. Just totally depends on what you're looking at. Little dips in audio ever so often, but not bad. Okay, I'm gonna clean this up next live. See what's going on. Let me make sure I'm not leaving out YouTube and X and Facebook, and get some questions answered over here. Audio's working. Okay, I'm looking good. Great. Okay. When you were sitting on cash in 2008 and started buying when everyone else was selling, how did you decide when to enter? This correction feels much smaller and less obvious as a potential entry point. Really, really good question. Okay, yeah, that's fair. 2008, it was obvious for everyone, right? It was like a freaking meltdown. I would say, honestly, one of the best strategies, I stick to it even to today, just dollar cost average. That will really help a lot of people know when to get in. But I think more, what's a little bit easier is more of your buy-sell discipline in your categories, right? Like, check on your categories. If they move by 10%, I think that's a good indicator that you need to look into potentially buying more or selling off, and then vice versa. So make sure you're sticking to your buy-sell discipline. A lot of people, this is known as rebalancing your portfolio. What about making the real estate investment as a loan versus equity? Really good question. I've been involved in both. I've lent out, I've bought. My company has done both, lent out and bought. You're going to get two different things, right? Lending in theory is less risky because when you're buying real estate, you're not lending up to the full value of the real estate assets. So let's say the real estate asset's worth $1 million, and you're going to lend somebody 65% of the loan to value. So that means you're going to give them 650 grand on an apartment or a home or something that's worth $1 million. So if you have to take it over, if they stop paying, you can make the argument that you just got an apartment or a home for 65 cents on the dollar. That is your protection for things that happen. Or that is your protection on if things go wrong. If you're in first position, you're the first one to get the asset when it becomes troubled. The thing, though, with that is with lending, if there's less risk, there's less return. So the yield that you're going to get, in theory, should be much smaller than if you were to buy equity or buy the apartment or the real estate asset. So with equity means you participate in appreciation, not just cash flow. So it really comes down to what you like. For me personally, I like buying them more than lending on them. A lot of that is my age. Like getting 8%, 9% on lending on real estate isn't as desirable as me trying to double my money every 4 to 5 years. I want to double my money. So that's one. Two, when you're lending, this is ordinary income. So you're taxed on this income. If you're buying it, there's a lot of ways for you to get cash flow that are not taxed. I want appreciation. Depreciation is a big factor. You get to depreciate these assets when you own them. So for me, I like buying them better. That is what I'm doing. I'm actually moving away from the lending side and going way heavier on the buy side. But my strategy for me and what works for me does not mean it has to be your strategy or work for you. Okay, have you ever done a subject to loan? I have never done one. I would absolutely do them. But in my area, there's not a lot of them. California, it's a harder market to do it. I would do it for like me buying a property, like a primary residence for sure. It's just there's not a lot of them and not my expertise. That's Pace's gig. So if you want to learn about subject to, go hit up Pace. Pace Morby's really good at it. All right, I'm going to get one more question, and I got to run into a sales meeting to see how the company is, what the week has looked like for people coming in. All right, what about making the real estate oh yeah, we just answered that. What are your thoughts on house hacking? I rent out 3 of my 4 bedrooms separately, and it pays my entire mortgage and utilities. Kevin, absolutely love it. Absolutely love it. Keep doing that. I would recommend house hacking for anyone who who can pull it off. When you start having kids, it gets a little bit harder. So if you're young, you're saving your money, you're wanting to buy a home, I would recommend house hacking first. Great way to really get in the investment game. All right, everybody, I love you guys. I hope everything is well. Don't fall into the hype this week. Don't pay attention to the headlines. Stay disciplined, stay hungry. Remember, life is good. If you're filling yourself and consuming your content and it's all fear-based, be careful with that. That'll creep into your outlook and it'll take all the joy out of your lives. Have a great week. Love you guys. I'll talk